The story you're about to hear doesn't start with bombs. It starts with a spreadsheet. At 2 in the morning in Washington, while cable news replayed shaky footage from Caracas and commentators argued about freedom and democracy, something far quieter happened. A set of dollar flows stopped behaving the way they were supposed to. Not dramatically, not all at once, just enough to make a few very nervous people in the Treasury notice. Here's the uncomfortable truth. The U.S. didn't move on Venezuela to protect the dollar. It moved because the dollar was already in trouble, and the irony is brutal. In trying to save the petrodollar system, Washington may have just dealt it its most serious blow. To understand why this matters right now, you have to forget the headlines for a moment. Forget Maduro. Forget sanctions. Forget the speeches. This isn't really about Venezuela. Venezuela is just the stage. The real drama is about how the U.S. pays its bills, why oil matters more than almost any other commodity, and what happens when a system built in the 1970s starts cracking under 21st century pressure. Let's rewind. For decades, the United States has enjoyed a privilege no other country has ever had at this scale. It can print the world's main money, not just for Americans, for everyone. Oil is priced in dollars. Major debts are settled in dollars. Central banks hoard dollars. Global trade runs through dollars. That's the petrodollar system. Here's the simple version. If you want oil, you need dollars. If you need dollars, you either earn them or borrow them. And if you borrow them, you're tied to the U.S. financial system. This creates constant global demand for U.S. dollars, which allows the U.S. government to run deficits that would collapse almost any other country. It's not magic, it's plumbing. Invisible, boring, and extremely powerful. But plumbing only works if everyone agrees not to mess with it. Venezuela did, not loudly, not overnight, but steadily. As sanctions tightened, Caracas started doing something that made Washington deeply uncomfortable. It sold oil outside the dollar system. First quietly, then openly, yuan, rubles, barter deals, gold-linked contracts, crypto experiments that mostly failed, but still sent a message. The message wasn't we hate the dollar. The message was we don't need it. And here's the part most people miss. Venezuela itself isn't big enough to kill the petrodollar. Its oil production is a shadow of what it once was. Its economy is wrecked. On paper, it shouldn't matter. But systems don't break because of one big blow. They break because of precedent. If Venezuela can sell oil without dollars and survive, even barely, then others start asking uncomfortable questions. What about Iran? Already experimenting. What about Russia? Already forced out. What about Saudi Arabia, quietly flirting with non-dollar settlements while smiling in Washington? This is where the story gets tense. Because around the same time Venezuela was pushing away from the dollar, something else was happening. U.S. debt exploded. Trillions added in just a few years, not abstract numbers. Real borrowing that has to be financed. And financing only works if there's global appetite for dollars and U.S. bonds. So imagine the math from Washington's point of view. More debt, more spending, higher interest rates, and a world slowly learning it doesn't need to play by dollar rules. That's not a future problem, that's a now problem. This is where Venezuela becomes more than a nuisance. It becomes a test case. Because if the U.S. lets a major oil producer openly operate outside the dollar system, it sends a signal that sanctions don't really enforce dollar dominance anymore. And once that signal spreads, the petrodollar stops being a rule and starts being a suggestion. Suggestions don't hold empires together. So pressure escalates, sanctions tighten, assets are frozen, diplomatic isolation increases, the narrative hardens. Democracy, human rights, stability, all familiar language. Not necessarily false, but incomplete. Here's the uncomfortable mechanism underneath. When a country is pushed out of the dollar system, it either collapses, or it innovates around it. If it collapses, the system looks strong. If it adapts, the system looks optional. Venezuela didn't collapse fast enough. Instead, it became a messy laboratory. Oil sold at discounts, new payment rails tested, shadow shipping networks, insurance workarounds. None of it pretty, none of it efficient, but enough to prove a point. And that point scared the wrong people. This is where the irony kicks in. By moving aggressively against Venezuela, the U.S. didn't just punish a defiant state, it accelerated global interest in alternatives. Countries watching didn't think, good, the dollar is safe. They thought, we need a backup plan. That's when the math gets ugly. Because the petrodollar isn't just about oil pricing. It's about recycling. Oil exporters earn dollars. They invest those dollars back into U.S. assets, treasuries, stocks, real estate. This keeps U.S. borrowing costs low. If oil trade fragments into multiple currencies, that recycling weakens. Not overnight, gradually, quietly. The most dangerous way, you don't see a collapse. You see slightly higher borrowing costs, slightly weaker demand at auctions, slightly more nervous central bankers. Until one day, it's not slight anymore. This is where hype versus reality diverge. The hype says the dollar is unchallenged, that alternatives are too fragmented, that crypto is a joke, that China's currency is controlled, that nothing can replace the dollar. The reality is harsher. The dollar doesn't need a replacement to lose power. It just needs competition. Think of it like gravity. You don't turn it off. You just add another force. Every oil contract settled outside dollars weakens the automatic demand loop. Every sanctioned country forced to build workarounds makes those workarounds better for the next one. Every weaponization of the dollar makes holding it feel less neutral. Venezuela didn't kill the petrodollar, but the response to Venezuela might have wounded it. And here's the quiet humor in all this. The U.S. has sanctioned, pressured, and postured to defend a system that only works when it looks boring and inevitable. Powerful systems hate attention. Zoom out, and the implications get bigger. If the petrodollar slowly erodes, the U.S. faces harder choices. Either raise taxes, cut spending, inflate away debt, or borrow at higher rates. None of these are politically comfortable. All of them change the social contract. Globally, countries hedge, gold reserves rise, currency swaps expand, regional trade agreements bypass traditional channels. Not because anyone wants chaos, because no one wants dependence. And this is the real risk. Not collapse, drift, a world where the dollar is still dominant, but not dominant enough to absorb endless deficits without consequence. A world where financial power is negotiated instead of assumed. So, where does that leave us? It leaves us with a question that no press conference will answer. Did the U.S. act decisively to save the petrodollar? Or did it reveal how fragile it has become? Because when you have to use force to defend a financial system, you're admitting something quietly, but profoundly important. You're admitting it no longer defends itself. And once that realization spreads, the real invasion isn't military. It's psychological. The next decade will tell us whether Venezuela was a footnote, or the moment the dollar's invisible armor cracked. And the uncomfortable part is this: by trying to save the system, the U.S. may have shown the world exactly where to push next. Thanks for watching.